Let me ask you something. If I told you your hotel ran at 85% occupancy last year, is that a good year or is that a bad year? Hotel owners would probably say it's good, right? Most GMs would say it's good. 85%, it's obviously the number the industry has been trained to celebrate. Once you hit it, you feel like things are working. But there's one small problem to it. I think occupancy tells you how many beds are taking. It doesn't tell you nothing about how much money you actually made filling them. And the gap between how full your hotel is versus how profitable you were, well, that's what this episode is all about. Last time we talked about the real cost of OTA dependency. If you haven't watched that video yet, go back there and watch it because this video is going to follow up on it. But I'll give you the short version. A 2 million euro property at 65% OTA dependency, it's roughly handing somewhere between 340 to 420,000 euros a year to platforms like booking.com. Not investing in it, handing it over completely. But today, I want to zoom out a little bit because I think OTA commissions are just one symptom of a bigger problem. The bigger problem is that much of the hotel industry has been measuring the wrong thing for 30 years. And whenever you measure the wrong thing, you optimize for the wrong thing. When you optimize for the wrong thing, you can be at 85% occupancy and still be quietly going broke. So let's talk about RevPAR. Revenue per available room. It's been the golden metric in hospitality for decades, right? Simple calculation, take your total room revenue divided by your total available rooms. Clean number, easy to benchmark against competitors, easy to track over time. And for a long time, it actually worked. It was a reasonable proxy for how well your hotel was performing. The problem is that it stopped working, and most of the industry hasn't caught up just yet. So here's why RevPAR breaks down. It only measures revenue. It says nothing, zero about what it costs to generate that revenue. Think about what's happened in the last 10 years. OTA commissions have gone up, labor costs have gone up. Industry data shows that labor has risen about 20% since 2019. And some properties, it now consumes over 40% of total revenue. Distribution costs have exploded and RevPAR just keeps stacking up, completely ignoring all of that. So you can have a great RevPAR year. Occupancy up, average daily rate up, everyone in the meeting is smiling, and your actual profit, the money that survives after all the costs are paid off, can be going in the opposite direction. So there's actually a term for this. The hotel industry calls it flow through. When your revenue increases, what percentage of that increase actually flows through to profit? Research shows that when revenue growth comes from occupancy gains, filling more rooms, only about 30% flow to the bottom line because every additional occupied room has a cost. Housekeeping, amenities, check in, laundry, you name it. You fill the room, you service the room. But when revenue growth comes from rate, charging more per room, flow through is closer to 60% because the room is already there. You're just getting paid more for it. RevPAR treats both the same way. GoPAR doesn't. So let's talk a little bit about GoPAR. Gross operating profit per available room. The calculation is simple. Take your gross operating profit, divide by your available rooms. What changes is what you're dividing. You're not dividing revenue. You're dividing actual profit after operating expenses are taken out. And suddenly, a very different picture emerges. So, a hotel running 85% occupancy with 70% of those bookings coming through OTA looks great on RevPAR. It might look terrible on GoPAR because before you get to the profit, you paid 18% commission on most of your revenue. You've paid to service all those rooms, you've paid for the brand protection ads we talked about in the last video, you've paid for the rebooking staff to manage a cancellation rate that for OTA bookings runs around 50% versus 18% for direct. By the time you get to GoPar, that 85% occupancy number is not telling the story you thought it was. Here's a real example of how this plays out. Two hotels, same market, same size, same average daily rate. Hotel A is at 80% occupancy, 35% OTA dependency, mostly direct bookings, strong CRM, repeat guest rate around 40%. Hotel B is 88% occupancy, 72% OTA dependency, high volume, high commission, low data ownership. Now, on RevPAR, Hotel B wins, obviously. Higher occupancy, same rate, better number. On GoPAR, Hotel A wins by a significant margin because the cost of generating Hotel B's occupancy is enormous, and almost none of those guests will ever be theirs to market to again. right? Hotel B is busier. Hotel A is more profitable. And in 10 years, Hotel A has a CRM full of loyal direct guests. Hotel B has a dependency on Booking.com that keeps getting worse. This is the trap, and it's everywhere in this industry. So, what do you do about it? First thing is start checking GoPAR. If your PMS doesn't surface it automatically, calculate it manually. Total gross operating profit divided by available rooms monthly. Run it alongside RevPAR. Watch the gap. The gap is going to tell you the story. Second, I want you to start measuring your cost of acquisition per channel. What does it actually cost you to acquire a direct booking versus an OTA booking? Direct booking acquisition costs typically run between 4 and 8% of the booking value. OTA commission runs 15 to 25%. That spread, that's your business case for every euro you invest in direct marketing. You're not spending money on marketing, you're actually buying back your margin. That's the way that I like to present it. Third, look at your channel mix as a profit lever, not just a distribution question. Every percentage point you shift from OTA to direct doesn't just save commissions. It improves your GoPAR, it increases your data ownership, it improves your cancellation rate, and it compounds over time. I really see it that the hotels that are going to be winning over the next decade are not the ones with the highest occupancy. They're going to be the ones who understand the difference between revenue and profit, between a full hotel and a profitable hotel. 85% occupancy is not a success story on its own. It's a starting point. The question is what it costs you to get there. Before next week, I want you to do one thing. Put your GoPAR for the last 12 months if you have it. If you don't, you can calculate it roughly. Gross operating profit divided by available room nights. Then look at it next to your RevPAR and your OTA percentage. You'll start seeing that relationship. On the next video, we're getting into direct booking specifically. What it actually costs to build a system that reduces OTA dependency in a way that's sustainable, not just a short-term spike. We're going to talk about the 90-day framework that we use at Resaco and the 3 things most hotels get wrong when they try to do this. Article for today is in the show notes. I'm Daniel Lauren once again. This is Hospitality Marketing Lab. See you next time.